Every single rupee sitting quietly in your savings account is currently operating inside one of the largest, most complex risk machines ever built. You think it's in a vault. It's actually suspended over an abyss. Let's look at Amit. Yesterday, he bought a stock for 85 rupees. Today, the price sits at 70 rupees. He lost 15 rupees overnight. That stings. But that 15 rupee drop is a negative return, a completed loss. The event is over. So what happens tomorrow? The price might bounce back. It might drop another 20 rupees. Nobody knows. That specific uncertainty about tomorrow's price is the actual risk. Risk is not the money you have already lost. Risk is entirely about the probability of what might happen next. This graph shows two different assets over time. The flat line is a slow, steady ride. The jagged line has massive drops and massive climbs. The direction of the swing doesn't define the risk. The sheer size of the potential drop is what makes that jagged line a high-risk asset. But notice those massive upward peaks on the volatile line. Higher risk usually carries the potential for a higher return. The market forces you to accept the possibility of a deep plunge if you want the chance at a steep climb. Great deeds are usually wrought at great risk. The Greek historian Herodotus wrote that 2,500 years ago. The relationship between high reward and high uncertainty is a historical law of nature. There is a catch. Those wild market swings mean absolutely nothing to you unless you own the asset. If Amit's neighbor watches that same stock plummet, he feels zero impact. The market will always dictate how violently an asset swings. You dictate your exposure to those swings. These charts show Amit investing 5,000 rupees and a mega bank investing 5 crore. Both drop by 50%. For Amit, losing 2,500 rupees is an annoyance. For the bank, it's 2.5 crore, a blow that could end their operation. This gap in consequence is why we talk about risk tolerance. It is the threshold where your personal capacity to survive a loss ends. Past this point, even a sound investment becomes a reckless gamble. Institutions have to enforce these boundaries ruthlessly to survive. Leonardo da Vinci observed that just as courage imperils life, fear protects it. The danger of a financial crash isn't determined by the asset. It is determined entirely by your capacity to absorb the blow. Because survival is on the line, global banks organize all their uncertainty into 3 distinct buckets. The rules for this come from the Basel Committee, the global referee for the banking system. The 3 Basel buckets. Column 1, credit risk. A borrower simply fails to repay their debt. Column 2, market risk, the danger of asset prices moving against you. Column 3, operational risk, internal failures like rogue employees, crashing IT systems, or cyber attacks. Banks use heavy mathematics to track these buckets, but models have limits. Former Fed Chairman Alan Greenspan famously said, "I would rather rely on the judgment of an experienced trader than the mathematical model of a PhD." Global banks do not stay in business by perfectly predicting the future. They stay in business by rigidly categorizing and containing every possible way they could fail. So what happens when a massive institution actually miscalculates its exposure limits across those 3 buckets? That triggers systemic risk. This occurs when a single institution's failure drags down its connected counterparties in a continuous, unstoppable chain reaction. We saw this materialize completely during the 2008 financial crisis. Global finance is heavily monitored for this exact reason. One unchecked miscalculation by a major player can pull the entire economic system down with it. Let's check back in on Amit. Against the odds, his stock unexpectedly bounced up to 100 rupees. He made a profit. His friend Priya sees the payout and claims it was a low-risk, high-reward move. Amit knows better now. Amit sees the truth. He just took a massive, unmanaged gamble that happened to end in a positive return. He got lucky. He didn't beat the risk. True financial literacy requires a shift in mindset. You have to stop hoping for positive outcomes and start calculating the size of the swing and intentionally managing your exposure to it. In our next video, we are going deep into that first bucket, credit risk. We'll look at the exact mechanics banks use to decide who gets a loan and why they reject millions of people every day. Subscribe so you don't miss it.